Hello, everyone. Welcome to today's FOMC meeting. And today we are going to discuss a lot of different things. We're going to look at dollar. We are going to look at gold. We are going to look at, well, oil. We're going to look at probably some Bitcoin. And we're going to look at, of course, we're going to look at S&P 500 at the stock market. Now, going forward, it is, well, depends on what Powell is going to provide for us in T17 minutes, T minus 17 minutes. But it is going to be whatever that is, and then we are definitely going to look into different scenarios before we head there. So this is an event that we have been having for quite some time. I'm just gonna go. Yeah, I'm just gonna do something. I forgot to do something, but something is coming. Sir, why are you so red? Well, let's talk about the cat at the back. There is sunshine in Kenya. And I went out because there was no power inside the house while you're inside the house in the sunshine. So I went out. Yes. I feel like a tomato. But yeah, oh yeah, so today we're gonna have a great day. Becky is laughing at me. So how are you? I am very well. I am very, very, very well. Hello, Kevin. I saw you coming in with the earliest of them all. If we go through some, I'm gonna try to trade this one. By the way, I'm gonna try to trade this one. The only thing that I'm gonna try to do at the moment is I just want to do one more fix idea that I have for this thing. So if I can just do that, that would be great. There we go. So what should we be posting here? So let's say trading 9 years experience. Maybe trade for 9 years. Traded for 9 years. Let's say and then mint. Then I'm just going to do that, and then we're probably going to reduce the size of it. And then we're just going to do that, and then that. Well, that was one part of it at least. And just move it all the way down. Do you think that will work? Maybe a bit more higher. So, nah, I don't. That is working okay. Well, it's just that it's not the same color. No, it doesn't work. Okay. I'm just gonna crawl to the cross and then move things over here and then see if it's okay. Okay, good. Sorry for this. 2 seconds. Current page. Thank you. Okay, cool. So where are we? Hi, Roxana. Hi, Call Me. Sorry. Hi, Call Me. Hi, boss. Hope you're fine. Long time no see. Long time no see. Can I just tell you guys one thing? It's hard being white. It's a hard thing to be white. Life is tough out there. I don't know how else I can say it. Nah, okay, fine. Okay. Okay. Oh, okay, there we go. Did that work? Probably, maybe. Okay. Hi, Marilyn. You look like Ben Stokes. Do you have a sunburn? Nah, not at all, people. Roxana is better than me. She's still trading Eurodollar to the short side. I'm probably gonna enjoy that as well. Okay. Okay. Can we just say if I haven't provided any value? Red as a crab. Yeah, I know. Long time no see, Michael, by the way. Long time no see. Okay, so going forward, where are we going? So we have a couple of scenarios here. Okay, so we have 10% of the market or 10% of TD, expecting 10%. Okay, 10% of it possibility of hawkishness, which is 75 basis points, and that the inflation is too high, and that they are suggesting another 75 basis points in December. That would send euro down and probably USD yen up. Base case is 75 basis point now, and they're saying that inflation is still strong and the labor market is also strong. That means that we are probably going to go up to 1 flat. That means we are going to go up here. I'm just going to tell you something, people. If price comes back up to this area, I am good as golden to go to the downside. Okay. How are you, MNFX? I'm doing very great. And you? Edward says, hey there, hey. Signs of Fed slowing down. No, Eugene, I don't think so. That is what I'm afraid of. Not necessarily what I kind of expect. I'm afraid of it. So that would send euro, dollar, somewhere in the region of 100 to 200 higher. That is that, okay? And then, of course, no, I haven't done that. Okay, so that is not desirable. I exited, I don't know, 98. So I got like $25 out of it. Little money for a little boy, but I just didn't bother. I'm not going to bother with. I had an entry at one. I had an entry up here somewhere, and I just okay, fine. It wasn't that high. One something, so something like that. So I just didn't bother to lose all that profit. When I see that we might go higher before falling if we hit base case, if we hit what the market is expecting already. Dovishly, the statement is saying that they're going to pivot, that they have improved consumer inflation, hints on front loading that we may be finished despite the need of tightening further. Powell suggests another 75 basis point in May. In December might not be necessary. So that is going to send probably USD yen lower. For those who are very interested in USD yen, that is 145 as expected. Yeah, that's definitely down to the previous lows, and that pretty quickly. Hello, Harold. Harold, our good friend. I saw your message. I pray for you. I hope everything is going to be okay. We are with you. You're not alone, and I hope that it's going to be okay in the end. Roxana says, I'm hoping a lot euro dollar going higher. I'm not saying that I'm just giving you the scenarios, okay? So we all hope and pray and we cross our toes. How do you cross toes? Cross fingers and toes. That is going to be okay. There is a Fed meeting today, Abbas. That is what is going on. And for the millionth time, I have the color white in my face normally, but today is color pink or red or tomato like. He just got sent. I was just I was just in the sun. I was I wasn't naughty. I was just being, I was just, what do you call it? I was just, I wasn't patiently. I was just being, innocently in the sun for 2 hours. Hi, Princely. I saw your message earlier. Hi, MP. Looking sharp. Of course, we're always looking sharp for Mr. Powell. So currently today, 75 basis point by 88% is currently priced in, and the next meeting most likely priced in 50 basis point. It has gone down. It was much higher on the 75 yesterday. Now it's gone down from 49 to 46. So yeah, some is still hoping for only 25 in December. But if that happens, yeah, Armageddon. Okay. Long time no see, Bert Jones. Professor. Yeah. I'm professor by now because it's so long time. I should have a PhD in losing money. But yeah, good vibes, Abbas. Good vibes. Yeah. So, going forward, there was yesterday on USD some dropping on USD and might have been this unconfirmed intervention from Bank of Japan. Just got to say that, yeah, somebody keep the time on me, all right? Keep the time on me, okay? Nobody has become members today because I always lose that. Okay, so somebody keep time, okay? That might also happen today if there's dollar bearishness. I'm just saying that Bank of Japan might be. I see an opportunity. But yeah, so going forward, that is just too much to talk about right now. I will just give it a link to you. You can just read it on the side later. Later, alligators. Later, alligators. There we go. Go. So I just put it in the Discord for you guys. Someone asking, are you from Norway? Am I from Norway? Yeah, maybe I am. Doesn't matter, does it? Do you think yen will be strong if central banks start focusing growth rates instead of inflation? Maybe initially. So today, with interest rate hikes, should we see dollar go higher? That is what I expect. That's what I want to see. Okay, so let's go for a slideshow. Okay, that was actually the wrong slideshow. Okay, can we portray to the next screen? Presenter's view. I want to start screen on another. Okay, idioter. Okay, whatever. Nah, wasn't that slideshow? Very good. FOMC. Good. Okay. What is FOMC about? Determine that it is their objective and their goal is to determine the direction. Is to determine the direction of the monetary policy. What is FOMC? Is a committee that decides monetary policy made up of 12 members, 7 from the Board of Governors of the Federal Reserve System, the President of the Federal Reserve Bank of New York, and 4 out of 7 Reserve Bank presidents. What do FOMC do? Influence the availability and the cost of money and credit to help promote national economic goals. And right now, increasing it so high that people stop spending money. How does changing in federal funds rate affect the market? Short-term interest rates affects long-term interest rates, the amount of money and credit, and ultimately the range of economic variables, including employment, output, prices of goods and services. What are the key indicators of Fed that they're using? Inflation, unemployment was the key indicators they're using. Inflation, unemployment, GDP, housing, household spending, consumer sentiment, business sentiment, manufacturing PMI, service PMI, composite PMI, bond market, stock market, forex market, commodities market, global market, fixed investments, and other risks to economic development. How does the Fed implement monetary policy? By lowering or rising at the moment Fed funds rate, bond purchase, and deposit. How is the goal? What is the goal? Inflation 2%, GDP 2.5, unemployment 3.5. Thank you very much. Okay, a round of applause. We have 2 minutes left. Okay, I will go into a different mode now. So where are we? There we are. So I'm just. Why did I keep that on? I mean, it's no time for it later. I finished. Two pumps on a cuddle. That's what I'm about. Finish quickly. This is about the Fed increasing interest rates or not, or how much, and how much that affects the market generally. Stock market, forex market, bond market, all the other markets, and Norway for that matter. Okay, so and then we need you to go there, and then we need you to go there, and then we go for two things here. That's USD yen, and then the other one should probably be euro dollar. If we can just get it on, thank you. It's difficult to push it in sometimes. We go down to 50-minute time frame just for the fun of it, and then 50-minute time frame here as well. Other than that, GG people, GG. There we go. It's supposed to be 4. Then I need to go to Federal Reserve. Time is up. Time is up. What is it? 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 Come on. Get it on. Dollar is falling. Dollar is falling. Come on, mate. Don't leave me hanging here. What on earth happened? Dollar strengthening again. Okay, I'm just going to reverse it again. Reserve it again then. PDF is out. Good to know. Thank you very much. And there we are. No. What is else? Investing.com. This is just shitty. Why is it not showing it to me? For crying out loud, mate. Dollar is weakening. I need to know. Like, why are you so terrible interesting? Okay. Does somebody knows here then? 75 basis points. Tradingview stuck. There we go. Finally, for crying out loud. Idiots. Komplett idioter. Okay. So, the Fed says, or immediate release at 2 p.m. EDT. Recent indicators points to modest growth in spending and production. Job gains has been robust in recent months, and employment rates have remained low. Inflation remained elevated, reflecting supply and demand imbalances related to the pandemic, high food prices. Nothing new. Russia war against Ukraine, causing tremendous human economic hardship. The war is related to creating additional upward pressure on inflation and weighing on global economic activity. So, the committee seeks to achieve 2%, whatever, and in pursuit of this goal, they decide to raise the target for federal funds rate to 3.75, anticipating to 3.75. Like, what am I missing here? Can somebody help me out? Why is dollar falling then? I need Joe now. Joe says just 75%. They will, in addition, continue to reduce the treasury securities and the agency the mortgage-backed securities, as described in the plans for reduction size of that. Ba-da-ba-da. 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 Okay. I don't see anything new though. That's the point. That's the problem, to be honest. But everything is stuck on my screen at the moment. To the moon, yeah. Hi. Nobody saw that actually. That's actually why I'm not understanding anything here. Okay, I was reading the wrong report for crying out loud. By the 2nd of November, 3.75% to 4%. I'm just trying to read into it. Okay. That's so be it. Everything is just downtown now. We believe that ongoing interest rate increases will be necessary to achieve sufficient restrictive policy stance. In determining the pace of rate hikes, we'll consider cumulative tightening, policy lags, and economic financial developments. Yeah, okay. Fine. I was wrong then. Euros going up, made money before going up. Great. The report looks to look at the summary economic projections. Okay, so we will just do that then. Okay, fair enough. So, as far as I can see, everything is just in line with what was expected. Everything went up. Hi, Xavier. So the other thing that I might need to look into, Mr. Joe, is the pivots. That's all. If they are seeing terminally that it won't not be above 5% by May. That's the only thing that I'm wondering about. But that's all. Okay. So until then, market is what it is. And it had a big pullback. USDN went lower. Euro dollar went higher. And I didn't lose anything on it. So I'm pretty happy on it. Bert Jones, what happened? So as far as I can see, it's only because I'm now just looking at it. It is just because it just came in as expected. Because I don't see anything new. But I want to see the comparison here. That's always great. So they have changed. So 3 to 3.25 to 4. The committee anticipates the ongoing increases in target range in order to attain a stance on monetary policy sufficiently restrictive to return to 2% inflation over time. In determining the pace of future interest rate, the target range, the committee will take into account cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation and economic financial developments. So I think the word that they're looking at, actually, to be honest, is this word that that's what they're reading into. Excuse me. It's the word lags. That can be read as pivoting, meaning that we currently might be going into more of a that they're seeing that their interest rates are high, and they need to start seeing what the effects actually are on the economic activity, and being more conscious about that they are so high at the moment that it's probably going to crush the economy more than they wanted. I think that's how that market reacts to it, and that sends dollar higher, that lower. Sorry, there's dollar there, and then there is S&P 500 also should go higher. Then now we just have 20 minutes to wait for Mr. Powell, while I still scan through what's being said. Mitchell says, "Why are you so red?" Because I'm blushing by the beauty of Jerome Powell. And you. I am sunburned. I was in the sun for 2 hours in Kenya. That's why. Bullish dollar in the long run. I still think that way. Yeah, nothing has really changed. It could read 5% in February 2023, but considering the announcement was in line with expectations, I think the terminal rate will be 475. Okay, so that means another 50 in December and another 25 in January, and then we are done by that, or February by that. But the man has been sad. I was actually just having a good time talking to a neighbor. Actually, he lost his business, so he was using my hanging line to wash all the clothes because of the clothing business that he was taking down. So yeah, he was a great guy. Had a good fun. And then I'm weak. I just made it. Can it be a long-term bull ride? Well, nothing has really changed dollar-wise. It's a short-term pullback on dollar. But the question comes out what Powell says about pivoting or indicating pivoting, and the word lags. That there's if they start to become concerned about their policy and that it lags of the economic effect, which it does, then yes, we see dollar falling as stock market rallying like crazy. Just do 1 basis point and start the crash. Michael Ford, pretty good actually. Do you know what, Harafa? I just took a trip to the moon. Oh yeah. Me and Black, I was taken out by $1. Yeah, I closed earlier. I can't remember the price I closed out at, but what price did I close out at? Got money in my pockets. Got money in my pockets. Got money in my pockets. Okay, come on. There's no internet on my phone now. Okay, cool. Thank you. Load. Please. Now. Yeah. Oh, finally, internet comes in on my phone and the whole thing just blows up. I got out at 98.91. So on euro, I got out 98.91. So somewhere there. That's all. Oh yeah. Use the Swissy. Okay, we can take a look at Swissy for a couple seconds. We forgot to look at gold though, but I guess that's higher. Yeah, nothing specific there. It's a range. It's supposed to go higher, but it kind of fell down again now. I don't like that low though. So bullishness, no. Bearishness, no. To be honest, the outlook should be higher. So I'll just wait for a new higher high, POV1, if that's ever is possible. Expectations is now dollar weakens until end of December. Okay. Then I need to discuss that with myself and see if I'm going to change because of that. But yeah. What about structural break of 110 on dollar? Yeah, also if we break below 110, yeah, then that's definitely different. Dollar weakness could even be extended into February meeting, depending on this when recessionary indicator starts to pop off. Okay. Yeah, that's actually true. Good morning, Denise. Good evening, actually. It's been a bit. Yeah, it's been. Sorry. Been working hard. So this downturn for dollar will continue until Monday. Yeah, so if you're a dollar bull, just hands up, pants down. Don't do anything right now. Don't buy it right now. Yeah. So me and Joe is a good trader of mine. So he is just as good as me or even better at something. So at this point, I'm just gonna say that if you are dollar bear, look for a pullback. Um oh, what did you say? Why is that right? Yeah. Yeah, I was just a little bit for 2 hours and then poof. So if you're looking for dollar bearishness, also sure I can look for that. That's the only way. That's the one way, and the other way is to look for continuation lower now. That we just fall on dollar, don't have a pullback. Because if this is a new trend, people, we're just gonna go. Nobody's gonna wait for you. Market's not gonna wait for you. You're not gonna we're not gonna wait for them. But this is pure technically more than anything else. Shake. I'm looking for sales on US 30. Can I sell now? No, you can't. I would say that so just wait for Jerome Powell to talk, and that might pop the stock market higher. And it all depends on very little things before that actually just takes off. So it's probably going to be the worst place to be at the moment. So I would just want you to not lose money. Okay. So yeah, just a break higher. So I think we'll break higher today. What about gold? Okay, we can do gold for 2 seconds. Yeah, I know. It was a good trade yesterday. Now it's broken. I mentioned if you sold the other day, I think can you hold it at 1670? I think or the previous high at 1666. And we are there now. But this isn't a sell anymore. So chill pill. There are more drivers of FX of than just cash rate. Yeah, I agree with you. I agree with you. How is it going, Denise? If not, you can tell me in Discord. It's been you've been a good friend for a long time. So tell me. Um, so what is the trade plan going forward now? I would say, chill it a bit. Is that a perfect? Is that a nice reversal on Aussie yen for Aussie dollar for that matter? Yen pairs. Oh, they're down. Okay. Okay. They're down, 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 down. USD and then ooh, beauty. Nay, Abbas. You're in live stream prison now. You're only gonna be here. Stop fighting. Just be here. We will take care of you. We'll give you food, we give you shelter, we give you internet, we give you power for you to trade every day. Okay? And looking ahead for an FP. That's another kicker in the leg though. Definitely. Also went long. Yeah. Well, you don't know that in advance, and that's not the point of trading. The point of trading is to put together the old amount of information that you have and try to make an educated guess or on what the future is going to hold, and depending on what you already know, and then you are going to put into the consideration technical analysis. So if you think that this dollar is going to fall now, Okay. Is this a good place to buy? Not at all. It's been an anise horribilis, as late Queen would say. I'm messaging you Discord. Yeah, thank you. I hope you can see me there. Need to rub it in their faces. Abbas is one of my great friends here. He's been trading with me for at least a year or so now, maybe even longer. We are growing old together. So, do you still have like COVID requirements to go to Bahrain? Maybe I should just pass by one day. I'm going to Qatar in December. Not for the football, but I'm just passing by on there. But on the way back from Norway to Kenya, I can pass by Bahrain. I bet it will be more like January, but we'll see. We'll see how traveling plans goes. So Aussie dollar, Euro dollar. Has Euro become bullish now? Is Euro a good buy now? No. Um, Nothing has changed technically, other than just pushed higher a bit. But I think it's going to continue higher if Jerome Powell in 10 minutes now starts speaking. And so I'm not buying the dollar for the life of me. I wanted to trade, but this is a deadliest catch, to be honest. Um oh, yeah, that's just funny. Uh, it's just, I sent a video to one of the people here earlier, where a woman said that she had to have a husband that made more than her, because she was just going to be a trophy wife. She was just going to be taking. She was just going to be home, and she was gonna live the. She didn't say live the dream, but she said some of the in the regions of I'm just going to be. I'm just going to live life. Um, and then one guy replies back, so if something happens to the husband, like something happens with the business or it goes down, like he doesn't make money anymore, what do you do then? She's like, well, I will just get a new one. for crying out loud, please. I didn't know we can just buy a husband on the store. That's kind of my 10-year T note is barely moving, to be honest. I'll see you, Abbas. I see you. So yeah, that's the video I sent him, and no matter what, I didn't do it. But life also. You're on New Zealand. Okay, so the story here is, and if you are here, Mr. Charlie, whoever Charlie is, Charlie bit my finger. Dude, he sold M3 up here and he's in profit through the moons. He's a mentorship student and been going through whatever, but that doesn't matter. But he just followed the strategy or whatever he planned out. Okay, sell M3 for October. Okay, went sideways, side of subbage, and then went lower again. And sure do. That's actually almost straight. Tons of profit. Well, how much is it? I don't know. 700 pips. Can't complain. Roxana is laughing. At least the woman in here is. Charlie's here! The legend, the myth. Aye. I'm just going to tell you guys a trade he took one time. I can't remember which pair it was, but it was probably New Zealand yen. I'm just going to tell you guys. I'm going to tell him, okay? People, he bought New Zealand yen at 80, 70 something or 80 something. He bought down here, for crying out loud. He's even better than me. that's how good it can become. As a take my hat off to Take my hat off to you. Sure, I don't have a hat on me now, do I? Where's my cap? No cap though. But yeah, maybe I should do that. Maybe I should find a cap. Okay, just 2 seconds. Okay. Harold says if you could trade in wives, I'd like to exchange 1.1 loss in trade. Oh no, 1.1 liter for a 2.0 GTI. I'll find it later. The legend, the myth. And then what else did you do over in June or July? You sold somewhere here or something. June or July was fantastic for you. So now I'm just gonna praise you. I'm good to go. Don't say that, mate. I'm trying to give you confidence to do it. Because once you start fiddling around with my strategy, I would say the things just comes down to your brain. It just takes how long time. It comes down to how long time does it take for you to be humble enough to understand that it's not about you, it's about the market, and it's about you taking trading seriously and objectively and systematically. And whenever you take a trade and you hit your stop loss, it's okay, move on. Follow the system, follow the strategy, backtest it, make it your own, try out, then go real. When you have tried, you know exactly what to do. He tested out which stop loss, which targets, which seasonal patterns should he be trading. He tested out every single bit. I would say it's even profitable because you have more money in your trading account now than you had before you started with me. Yes, mate. I want to short the FMC flipped it. Yeah. Let me tell you something for free. First of all, mate, I would say that a sell, to be honest, should be somewhere in this region here. So either there, somewhere there. Mostly there. So if it goes higher, I would say, aha, that's great. Go up to 136.23. Right now it's a bit late, and I would even say 135.50 to sell it again. Okay, so even though you feel like it's flipped, I would say go higher, get a better entry so you can sell it again. Okay, so it is 5 minutes left until the YouTube. So what do I do here on YouTube? I'm supposed to be streaming every day. I don't, but that's do. Don't care about that. Trade every day. I swing trade, day trade, position trade. Fundamentals is key. Technicals is just to enter, and then I use paper points to get my target. Don't need to use it. Just use price action for that matter. But yeah. So I have 40% in the bank since August. That is my results only. And I have used Blueberry Markets as my broker. So if that's something you want to do, go ahead, join in the club. But you don't need to. But it's a good club. It's a nice club. So where are we now? I was supposed to go to check YouTube because we are going to look forward to Mr. FOMC meeting live. And we have to go to Gov, probably, Federal Reserve. Fed. Should I sing for you guys? Federal Reserve. There you go. Good. Okay. Just gonna keep that annoying music in the background. So I'm just gonna put him. Sorry, I'm just gonna put them into like a very small window. I think that's what we're gonna do. Just put them in a small window. So in case they start doing something, we have them ready available. Okay. Good. So where are you guys there? There you guys are. So you're a cat. I wouldn't trade it. I wait for a higher high. Sorry, wait for higher prices actually. Pound came up actually, stopped so far. USD cat is just a bloody nightmare. Nothing to do here. I wouldn't even wish it upon my worst enemy that you guys are trading that actually. I wouldn't wish it upon my worst nightmare. Okay, no, my worst enemy. So just keep away. Okay. CAD yen, is that strengthening now for some reason? No, flat. Euro, nothing. CAD, pound, nothing. Aussie yen, okay, we can talk, but still not bullish. So I can see Norwegian news says that there is a sign that Federal Reserve will slow down the rate hikes, and that is what we're going to. That's what we're going to listen out for today from Jerome Powell. Is what is that something close to something, or if that is not so close to something? So give it a couple of seconds left now, and I will hear him out. So I'm just need to press stop screen, slides, extra camera, no, stop sharing. Hey, share screen, share audio. There we go. And then we are gonna wait until he says something, and then how to get more views, everyone trading, yeah, some other people out there. So we shall see if so I would say that dollar will continue weakening across now when he's speaking, and unless he is coming around and say, hey, something nothing has changed, we're just going to continue on as he did on the when CPI was inflationary. He just kept on going like, hey, it's still inflationary. You're still in dollar. I don't have anything there yet, Newman. Still in the dark there. Isn't he supposed to come out soon? And have they turned off the microphone or something? Or is it just me that has turned it off? Because I was listening to the sound earlier. Check. Okay, there. Okay. Good. Okay. The other thing to mention here is CPI is high, but it's not increasing high very fast, very quickly. So that's going to be the main point to listen to today.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and let's say the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple of things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context.
Juicy question.
Of our broader tightening program, if I may, and hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was and has been how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement because that really does become the important question we think now is how far to go. And I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy, as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this. And as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamarosa, the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high fours, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view, but I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Gina. Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have, a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so The way I would think about that is, it's a commonly for a long time thought that monetary policy works with long and variable lags, and that it works first on financial conditions, and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is, we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking, what is the central bank going to do? And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing that I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lags. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Oh, housing, the housing part of it. Yeah. So, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers. And I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages. So I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's a picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening, and maybe that's there, but it's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tauchi from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the US that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts.
Okay, so just for context here, people, I'm just going to point out one thing. Why are they not caring about ICE outside, about Bank of whatever? Well, they do care about Bank of England and everything, but if you look at the economy of the American economy, I would understand her question if it was a significant portion of their GDP, of their economic performance, was based upon others. It's not. It's based. America is doing very well by themselves. So whatever's going on around in the UK, give two hoots. Doesn't matter.
It's both, through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine. And, we're seeing China's having issues with the zero COVID policy and, much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but, we have it, and we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas. And they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer term inflation expectations anchored and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Oh, no.
Hi, Chair Powell, Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what
this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common.
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of us, one of the policymakers violates or falls short of those rules, we do risk undermining that trust. And we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. And we've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that
I'm telling you, he's not commenting. He's not commenting. He's dodging the question. He's dodging the question. He's not commenting.
the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make was covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens. So there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted, and also you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts, or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over tighten, and we don't want to, we want to get this exactly right. But if we over tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it. You have to go back in. By then, the risk really is that it has become entrenched in people's thinking. And the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, it doesn't. We'll have to see. There's been no decision or discussion around exactly what steps we would take at that point, but the first thing is to find your way there.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up in, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because that for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as people as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming. Okay. But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how much that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher. And that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and, that'll end when it ends. But there's no sense that
Do better questions than that.
Inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So those I control those messages, and that's my job.
Edward. Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
You know, in theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, but people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of
Thanks, Hossein. Thanks.
Last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data is a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
Just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
All right. So what do we say now, people? What do we say to that? Yeah, okay. I was wrong. I can take that anytime, any day, to be honest. Gold is lower. Let's say gold is lower. Euro is lower. Aussie is lower. Fantastic entries for those who have the courage to do it. To be honest, I think we're going to see lower lows on Euro and Aussie. To be honest, yen pairs are doing yen pairs what yen pairs does best. Nothing to FOMC. Can't sell euro, pound, or anything now, but there is definitely going to be actions later on. What he basically said, he's not pausing. And what did I say? It's premature to pause. And he also said that it's yeah. He said earlier what this is something about the stock market going down. Lag doesn't mean slowing interest rates. Those two comments meaning he's still very bullish. So dollar strength, yes. I think that's good enough for everyone. I'm not going to bore you bore you more than that. There is no daily setups today. It's going to be daily setups tomorrow. There's going to be volatility now. So for those who sold, I saw somebody selling euro dollar 99.44. Congratulations. The other guy said that you should sell, where I said you should look for a buy. Okay, cool. Also, I don't care two hoots. I didn't lose anything. And yeah, I would like to have sold the euro dollar, Aussie dollar by now, but you know, I didn't do it because I was really scared that he will say something bearish and then poof, take all my profits. So, all in all, it's a good day. I am a bit lower than my exit right now, but all in all, it's a good day. If we break lower, I think we're going to go a bit lower. And then by the end of it, I think that we are going to see euro going down to 97.50 by the end of it. Okay, good. See you soon. Have a great day. I know I'm sunburned. Don't care. Okay? Boom. See you guys tomorrow.